Today, we're diving into a vital and often overlooked topic for anyone who's serious about safeguarding their family's financial future: inheritance tax planning. Inheritance tax, or IHT, is one of the most significant financial challenges faced by families across the UK. Many are unaware that without proactive planning, their loved ones could face a hefty tax bill on the assets they've worked tirelessly to build. Imagine spending your life accumulating wealth, only to have a significant portion of it diminish because of tax regulations. It's not just disheartening, it's avoidable. Here's a silver lining. With the right strategies, you can minimize or even eliminate a large part of this tax burden, ensuring that your legacy stays intact for future generations. In today's video, we'll break down the complex world of IHT into 5 clear and actionable chapters. You'll learn everything from the basics of tax thresholds to advanced strategies like legal exemptions and reliefs that can drastically reduce your liability. And to make these concepts even more tangible, we'll walk you through a real-life case study illustrating how a couple like John and Mary successfully used inheritance tax planning to protect their estate, ensuring their children benefited from the wealth they worked so hard to build. By the end of this video, you'll have a solid understanding of how to safeguard your estate from IHT, allowing you to pass down your wealth without unnecessary deductions. Let's start with the basics. What exactly is inheritance tax? In the UK, inheritance tax is a tax on the estate, that is the property, money and possessions of someone who has passed away. The standard rate of IHT is 40%, but the good news is that it only applies to the portion of the estate that's above the £325,000 threshold. This threshold is referred to as the nil-rate band. For example, if your estate is worth £500,000, only £175,000, 500,000 minus 325, would be subject to the 40% tax rate. Even then, there are ways to reduce this further. One key element is to consider the residence nil-rate band. This allows for an additional £175,000 exemption if you're leaving your home to a direct descendant, as a child, grandchild, or other close relative. For married couples or civil partners, this combined allowance could reach £1 million, potentially eliminating any IHT liability if your estate falls within these limits. But don't be fooled. It's not always as simple as it sounds. The rules around IHT are complex, and without a solid understanding of how allowances work, families can still end up paying more tax than necessary. That's why early planning is crucial. One of the most effective ways to reduce your inheritance tax liability is through gifting. By giving away some of your assets during your lifetime, you can lower the total value of your estate, ensuring more of it passes on to your loved ones tax-free. There are several types of gifts under the UK tax system that are either completely tax-free or partially exempt. The annual gift exemption allows you to gift up to £3,000 per tax year without it counting towards your estate's value. If you didn't use the previous year's exemption, you can carry over to the current year, allowing you to gift up to £6,000 in a single year. The small gifts exemption means you can give up to £250 per person per tax year to as many people as you like, with no tax implications. You can give tax-free wedding gifts of up to £5,000 to your children, £2,500 to your grandchildren, and £1,000 to other individuals. Potentially exempt transfers, referred to as pets, are larger gifts that become exempt from IHT if you survive for 7 years after making the gift. However, if you don't survive the full 7 years, a tapered tax rate applies based on how long it's been since the gift was made. But be mindful of the gifts with reservation of benefit rule. This applies if you give away an asset but continue to benefit from it, such as giving your home to your children while continuing to live there. In such cases, the asset will still be considered part of your estate for IHT purposes. Trusts are another excellent tool for inheritance tax planning. They allow you to transfer assets out of your estate while retaining some of the control over how and when the assets are distributed. Let's take a look at some commonly used trusts for IHT planning. With discretionary trusts, the trustees, who could include yourself, decide how and when the beneficiaries receive the assets, and allow trustees to change beneficiaries of the trust. The key advantage, as with other trusts, is that the assets held within the trust are not part of your estate and are therefore not subject to IHT upon your death. A bare trust, also known as absolute trust, gives the beneficiary an immediate right to the assets, meaning the assets will be taxed as part of their estate rather than yours. Downside is that the beneficiary may face capital gains tax or income tax on the assets. Beneficiaries of bare trusts, unlike discretionary trusts, are predetermined and can't be changed. Loan trusts and discounted gift trusts are specialized trusts that allow you to retain access to some of the income or capital while still reducing the inheritance tax burden on your estate. While trusts can be powerful, they can also be complex and have tax implications, such as periodic charges every 10 years and exit charges when assets are removed from a discretionary trust. It's crucial to seek professional advice to ensure your trust is set up correctly and tailored to your specific situation. Life insurance and pensions are two additional extremely effective ways to protect your estate from inheritance tax. One popular strategy is taking out a life insurance policy specifically to cover your potential IHT liability. For example, if your estate is worth £1 million and you expect an inheritance tax bill of $270,000, life insurance policy could provide your beneficiaries with the funds to cover the tax bill. The key here is to ensure the policy is written in trust, so it doesn't form part of your estate and become subject to IHT itself. Pensions are an incredibly tax-efficient way to pass on wealth because the value of your pension doesn't typically form part of your estate for IHT purposes. If you pass away before the age of 75, your beneficiaries can take your pension benefits tax-free. If you pass away after 75, they'll pay income tax at their marginal rate, but still, no IHT will apply. By leaving wealth in your pension and drawing from other sources during retirement, you can maximize a tax-efficient transfer of wealth to your heirs. Now, let's look at a real-life case study to see how these strategies work in action. Meet John and Mary, a married couple in their late 60s. Their combined estate, including their home, is valued at £1.2 million. Initially, they faced an IHT bill of £80,000 after fully utilising their nil-rate bands and residence nil-rate bands. Here's how they approached their inheritance tax planning. John and Mary started gifting £6,000 annually to their 2 children and 4 grandchildren. Over 10 years, this reduced the value of their estate by £60,000, saving them £24,000 in inheritance tax. They placed £100,000 of their investments into a discretionary trust, removing this amount from their estate. This saved an additional £40,000 in inheritance tax. They also took out a £50,000 life insurance policy written in trust to cover any future IHT liability, including future growth on their investments. This ensures no part of their estate would need to be sold to pay the tax. John and Mary left their pensions untouched, relying on their other investments for living expenses. This allowed them to pass on their pension funds IHT-free to their children. Through these combined strategies, John and Mary were able to reduce their IHT liability to zero, ensuring their estate was passed down to their family in full. Inheritance tax planning is a critical step in protecting your wealth for future generations. Whether you're gifting assets or setting up trusts or using life insurance and pensions, there are multiple strategies that can help you minimize the IHT burden on your estate. However, it's important to remember that every situation is unique. What works for one family may not work for another. Seeking professional advice tailored to your specific circumstances is key to developing an effective inheritance tax plan. We hope this video has provided you with valuable insights into inheritance tax planning. If you found this information helpful, give this video a thumbs up, subscribe to our channel, and hit the notification bell so you don't miss any of our future content. If you have any questions or topics you'd like us to cover, drop a comment below or get in touch with us using the link in the description. Also, make sure to check out the Xenia Learning page, which we've linked in the description box too. There, you'll find further reading materials, as well as a full transcript of today's video, so you can revisit any of the key points we covered. Lastly, always seek professional financial advice that's tailored to your personal situation before making any estate planning decisions. Every financial journey is different, and a professional can help guide you in the right direction. As always, plan smart and prosper.